All right, all right. Let me see if we figure this out real quick. That's dope. Zena, I'm gonna invite you right now. Let me just figure this out real quick. There we Hey, how are you?
Hi, how are you?
I'm good. You can hear me good?
Yes, I can hear you good. Can you hear me good?
Yeah, yeah. Let me see. I got some. I know you're busy, so I'm gonna see if I run through all this. I know you got a lot of gems to share, so I'm hoping that you can feed us. Let me see. Let me just wait, see if a few more people pop up. I know I have a lot of artists that are interested actually, so I'm kind of like curious to see how that's gonna play out on my side. Oh, where are you based?
I'm actually from New Jersey, but I'm in Chicago currently.
Okay, so you're not that well. I'm in New York, so I'm not that far from you. So whenever you're out here, let's link up.
Okay.
So actually, I wanted to start off by saying you're great. I like that all of your posts is interesting to me. I found you through other pages like Matt the Mortgage Guy and a few other people. So yeah, so through the comments, like me, I'm into real estate, so I study everybody. I study what they say. I want to know what they have to offer,
Hmm.
and that's how I found you. So I'm actually happy to be able to show love, bring light to all that you do. And if you want to let the people know like what you've been doing, what you've been into.
Sure, sure. And I just want to say I read the comments too. Like I'm an avid reader because people that's not big on social media or big have big Instagram accounts, they are in the trenches. So they have a lot of good gems to share. So I'm always in the comments. But yeah, my name is Zena Dixon. I am a real estate investor. I've been an investor for just over a year. Actually, I celebrated my anniversary of owning my first property on the 29th.
That
So
is awesome. That is great. I know. I wanted to ask you, like, how were the nerves? Like, were you freaking out during that process when you were buying last year?
oh my God, yes.
Yeah, because I know, like, for a house we were freaking out, but for a building that's a whole different anxiety.
It was crazy because one, I didn't even know that that was something that I could do. I learned that I could do that on social media. When the
Wow.
when the pandemic hit, everybody was sent home to work and you're scrolling on Instagram and I don't know how I got into a rabbit hole, but I got into a rabbit hole about, generational wealth and buying property and multifamily. And just when I delved into it, it just made a lot of sense to me. I was like, so you can get qualified for one family and rock out with that, but you can also get qualified for a multifamily that you don't even have to pay for. Your tenants will pay for. I was like, sign me up. Let's do it.
Yeah. And from my experience, I ended up finding out that it's easier to qualify for a multi for that exact reason, because then they'll qualify all the tenants and that income to be able to pay that mortgage. So it's actually a good thing for everyone to know.
Exactly. Exactly. That was like the turning point for me because I was just like, you're telling me I can acquire a property, my tenants are going to pay the mortgage, I'm going to cash flow, and I own this thing. It was just a no-brainer to me, and I wish that me and my husband knew that before we bought our first home, like our marital home, because that is such a play to have a multifamily and then like maybe get a 3 unit and then a duplex and then buy your dream home or your marital home,
Yeah.
because then your assets are paying the mortgage and you basically living free. And a lot of people, for everybody that I know, their housing expense is the biggest bill that they have, whether it's a mortgage or the rent. So if you can eliminate that, could you imagine how much you can move in the world to do the things that you want to do, whether it's
Yes.
vacation or invest in other things or start a business? That just frees up a lot of money when you work strategically to acquire property that's going to pay you.
Yes. Like today, I'll give you a perfect example. I dropped off my son at daycare, and him not wanting to let go of me because I had to go to work. That kind of like messes with you, right? So
Yes.
after a while, you're like, I have to make some changes because if not, I'm gonna work forever. And if
Yeah.
I work forever, we're not gonna enjoy life, right?
Exactly. Because, like when you retire, I think retirement age is what, 67 or something like that. at that age, you not all, your body ain't all that, you know. You go to the beach, you got to be covered up. You don't have the energy to really, you know, enjoy the vacations that you're trying to take. So I want to enjoy things while I still got my cute little body, and my husband can enjoy looking at it, you know. When we still have energy to, you know, go to the club and dance all night. Like, for me, like, learning about how I could leverage, you know, my paycheck, my 9-to-5 paycheck, to buy me assets that's going to eventually buy my freedom. That's all I needed to know. I sat my husband down and I said, look, this is what we're going to get into. And he was totally with it. He understood, you know, the plan, and he just jumped in right in with me. Like, he was just like, it makes sense to me. Let's go. So he burrs single families in Philly, and I buy the multifamilies in Chicago.
Wow, that's awesome. So you guys are operating together but separately.
Yes.
So
yes.
you personally, I mean, I don't want to get into your business, but you guys have your own business, or you guys under one umbrella?
We do. We have one umbrella, and then we have two separate businesses. And, you know, from, you know, LLCs, you want to protect different entities in different ways. So, like, for me with the multifamilies, that's under one umbrella. Him with the BRRRRs, that's under one umbrella. And then when it changes into a rental, that becomes another umbrella. So you just have these different entities set up for different phases of your business.
Yeah. Oh, so let me ask you a question, because I didn't write this down actually, but I kind of have an idea what the BRRRR system is, but can you explain like what that implies? Like what is that all about? Absolutely.
So there's two ways to go about BRRRRs, and for my clients, I teach them to use the 203K loan from FHA, but I'll explain what my husband does, and then I'll go back to FHA. So my husband, what he does is he buys undervalued, distressed properties in Philly. So he'll pay like maybe $50,000, $70,000. He'll put like $120,000 into it. So that's your construction cost, and then on the other side of that, once everything is done, you're probably all in for like 200, 210, and then the property appraises, or the ARV, or the after repair value for comparable properties in the area is probably like 350, 400. So the difference in that money of you being all in and the ARV is money that you can potentially take out when you do a refinance. So the BRRRR stands for buy, rehab, rent, refinance, and repeat. So that's pretty much what you do. You buy, you get your crew together. You know, you want to find you some good contractors, and it's really great if you can get contractors that want to partner with you, because then you can say, all right, so I got this property. This is the ARV. If you guys will front the work on the back end, we could split the profits. So that's another way that, you know, you can try and leverage your network, especially if you grew up with guys that's now in construction. You'd be like, hey, I'm doing this thing. Let's get into this together. And that could be attractive to them because you're bringing the value, because you're leveraging your capital to acquire the property. They're leveraging their expertise in the construction, and then on the back end, everybody gets paid. So it's just like, you know, a win-win situation for everyone.
For everyone, okay.
So with the FHA, and I like to call this BRRRR on training wheels, because it really helps people that want to get into that space but don't have the experience, have somebody hold their hand through the process. So what happens is, again, you find a distressed property, and I want to give you a tip on that, so remind me.
Okay.
Find a distressed property, and you know, you enter into the loan with FHA. You tell them, I want to, you know, get a construction loan for this. They will send out a FHA consultant to go through, you know, the property to get an idea of the scope of work. You find a contractor that.
This happens beforehand, before you do any work?
This happens before you do any work.
Okay. Yep.
Yes. Because you have to establish the scope of work so the bank will okay it. So what happens is, you know, you find a contractor that's familiar with FHA, because a lot of contractors don't do it because they don't get paid on the front end. So the contractor gives them the scope of work. The FHA consultant says, okay, this looks good. This looks good. I need you to drop this price down because that's a little high. So the FHA consultant, he keeps your budget in line. He makes sure that you're not being overcharged, and he keeps the project on schedule. So once the budget has been approved and the bank approves it, then you get a loan for 3.5% down on the purchase and the construction. So during the construction phase, your FHA consultant is going out and meeting with the contractor, making sure that they stay on budget in a timeline. Once a particular set of work is done, they will give them a draw, which is a payment. And it just happens like that until the job is complete. So basically, you as the new homeowner, you're just like on the sidelines watching this whole thing occur, but you're not managing the project, which is good because you can watch from afar and not get caught up in the stress of trying to manage a project by yourself.
Especially if you don't know. Actually, somebody has a question here. How do you guys find distressed homes? Are these foreclosure homes or homes you guys go door to door?
So it's a lot of different ways that you can get into distressed properties. One of the best ways is having a good wholesale relationship with good wholesalers. And I say good wholesalers because some wholesalers are out there moving real raggedy and they're trying to get you to pay retail for a distressed property. And you know, that's not how the game works. When a wholesaler acquires a property, it's really, really undervalued. They find a super motivated seller that's like, you know, I inherited this house, I don't want it, or you know, big mama, she passed away and I don't know what to do with this house, or it's just in such disrepair and they don't have the money to fix it. So they're just like, I'll give you, you know, give me $10,000 and you can take it off my hands. So the seller will acquire that property for $10,000 and then they'll try to sell it for like maybe $20,000 so they can have a spread of $10,000 that they make on the property.
Makes sense. So they're getting contracts signed. They're not acquiring property. They're just getting the permission. Basically.
It's a sign. Yes, it's assigned to them. Yeah, they have this. So, so they, you know, they reach out to their investors. A lot of wholesalers have lists, and they'll say, "Hey guys, I have this property for $25,000." And you as the buyer, the investor, you don't know what they pay for it until you get the HUD. But at that point, it's a dub, but you still got a property at, you know, a really low value, and now when you do your construction, you will still make money on a deal.
Wow, that's awesome. I didn't know that, actually.
Yeah.
There's a girl that I follow. Her name is Hot Toddy. I don't know if you know who she is, but I'll put you on to her. That's all she does. All she's on Instagram, just showing all these contracts, all these wholesale. Yeah, so I'll put you on to her.
Need to know her. And then another way to find distressed properties is PropStream. That's a service that you can pay for. A lot of investors know about this. And basically you can do a search. You can do a search on probate, you know, cases that just into probate. You can look for people, owners that live, you know, out of state. You could look for recent divorces. Like, it's a lot of criteria that you can search upon. And you can see, you know, people that might be in a situation where they're like, I really need to get rid of this property, like somebody that's in pre-foreclosure or something like that. So that's another tool that you can use. The other tool that's free is driving for dollars. You know, you just get in your car and you drive around in the area that you think you want to buy in. And if you see like the property is in disarray, the grass is high, the mail is piling up, it just unkept. You'll go on PropStream, you'll put in that address so you can get the seller or the owner's information and reach out to them. Hey, I saw this property, and you know, I'm interested in buying it. Are you interested in selling it? You know, you just start a dialogue with them, and more than likely, you know, if the property is unkept, they're going to be like, yeah, let's do something.
Let's do something. Yeah, there's a property actually near me that I call the Jumanji home because they have trees and branches growing all in the front porch. It looks like they need to like figure it out.
That's
so maybe I should knock on their door then.
Absolutely.
Okay, so you told me about that. All right, can you explain to me, like I have an idea because I actually have an FHA loan, but I want to hear from your expertise. What is the FHA and NACA loans, and how can you utilize them for your property investments?
So FHA and NACA, I always say that's the easiest and the least path of resistance to getting your first investment property. So FHA is a federally funded mortgage product where they have lenient requirements to get into those loans. So your credit doesn't have to be super great. Your debt to income doesn't have to be super low. And so they work with people that, you know, don't have stellar credit and don't have a lot of money to put down, right? So you're able to get into those loans. With FHA, you need a credit score of 580. I always tell my clients, I want you to have at least, you know, 600, 620, because when you get that first inquiry, to get a pre-approval,
Gonna
it's
drop you
down, and then you won't qualify for the 3.5% down. So you always want to be over 580 in terms of your credit score. And for the down payment, I stress, look for free money before you take out of your pocket. So I'm going to give you two ways. So the first way is to look for down payment assistance programs in your area. So go to your local bank, find out what their mortgage products are, because they may do FHA, and they may have a loan where it's no money down.
okay.
I know that Navy Federal has a no money down loan, but it's only for 2 units. So I told them, I was like, you need to make that a 4 unit. And the other banks, they give you like $17,000 for down payment. I think that's with Bank of America. So check your local banks first, call around, see what their loan products are, see what their down payment assistance is. So that's the first way. The second way is credit unions. Also check with credit unions. And then the third way is to contact your local county, city, and state to find out what their down payment programs are, because they're stackable. So if you qualify on county, city, and state level, those are stackable checks that you can get to go toward your down payment. And if your down payment is low and you get all of this extra down payment assistance money, you can use that for other things like your closing, or maybe new furniture for your new spot, So don't be afraid to open your mouth, because closed mouths don't get fed.
That's right. Now, question for you, like when you go out to get those incentives and apply for those programs, do you kind of have to have a property already in mind, like already like set? Because I know, I remember when I was reading, it said you had, well, one of the programs for Yonkers said that you had to have a property in contract before you apply. Is that something?
Yeah, absolutely. Okay. Because otherwise they'll be like, well, what you need the money for?
Yeah. Makes sense.
So, another way that you can get the down payment for a property is, and this is a little bit more advanced, and this is not something I really teach my clients, because some people are just not there yet. But a lot of people that I've been meeting, they own their own businesses. So if you're a business owner and you can apply for business credit cards. And typically when you're a new business and you apply for a new credit card, you can usually get a 0% APR card for like 12 months, 18 months or something like that. Mm-hmm. Those cards, you can take it and you can liquidate it. I use Plastique. That's a service that takes the money from the credit card and they'll, put it into your account via Plastique. Plastiquue.
I'm writing that down.
So you can use that to wire the money directly to the title company for the down payment, which I did on a property recently, or you can have them send a ACH to your bank account, and that money you can use again for your down payment. So you can use that. You can use a business credit card for your down payment on a property. And people will be like, well, how do I pay that back? Right. So if you get into a property, right, your business credit is not attached to your personal credit. So your utilization doesn't affect your personal credit. And then once you get into your property, say your down payment was $7,000, your monthly payment is like $100. I'm just throwing out numbers because I don't know for sure. But you can take your rentals and just make a automatic payment to the credit card company. So you haven't paid anything. All you did was leverage your good credit to get them, get you into a property.
Wow, that's awesome. Yeah, right now I'm big on business credit because I'm understanding the leveraging and the funding and right now I'll give you an example. When I apply for a personal credit, I would get approved maybe for 5, 6, and then they'll increase you. But for business on my Chase, as soon as I applied, I got $23,000. So I already know when I ask for an increase, I might be able to use that for something else.
Exactly. And it's so right, because Chase, they do give high limits for business. And I just asked for an increase and they gave me like $8,500 increase. So I'm just like thinking in my head, that's another down payment for another property.
Yeah. So let me ask you a question with that. Would that be considered like a balance transfer or a cash advance when you do that? When you liquefy it to your checking, like when you have them wire it to yourself. So
I haven't wired it to myself, but that would be a balance transfer.
Okay. And that's the one that you would want the 0 APR at least, so you can take advantage of it. Okay.
you want to make sure that the balance transfers are 0% as well, because sometimes that might not be the case. For me, I did a wire transfer, so they actually made a payment to someone. So, it's just going to be straight money, straight cash with no interest. But when you liquidate it and you put into your account, you want to make sure that balance transfers are 0% for that 12 or 18 months as well.
Okay. And in the underwriting process, do they ask you why, like, where's that money coming from? Who's that coming from?
They did not. So
okay.
For this investment property, they just wanted to, get the earnest money. They didn't ask me any questions. For FHA, they may ask. So if you are in the process, or you're thinking about, in the next couple of months, I want to buy a property, you should run that business card play now, so you can get the money into your account, so it's getting seasoned. So then when you go into underwriting, that money's been sitting there,
Yeah.
and they're none the wiser in terms of, she did, X, Y, and Z.
So I was told at least 6 months. Have it parked there.
Yeah, I think that, you should have some forethought if you're going to use the business credit route. Otherwise,
FHA, you're wasting time.
They're going to want to know where that money came from. Yeah. But for investment properties, they didn't ask me anything, because that actual purchase was going to be a hard money thing. So they didn't question it. All they want is their money.
Money. Yeah, that's true. Somebody has a question again. Let me see. During pre-approval, is there a certain time span you want to apply to different places so it doesn't hurt your credit on a hard inquiry?
Yes, you have 6 months from your first for your pre-approval. So the first pre-approval that you get, it lasts for 6 months. If you shop around for other banks and they do hard inquiries, they the credit bureaus are supposed to roll those all up into one. So if you see that they don't do that, you have to call them and say, I've been shopping for a mortgage. I'm not sure of the law, but I can DM it to you, and we can share it with the
dispute it though, right? Pretty much, so they could yeah.
Know that I was shopping for a mortgage during this time, and these should come off. It should only be one inquiry for that pre-approval.
Yeah, that could be an easy 24 points off right there.
Oh my God, yeah.
That's crazy. Okay, so can you give me some tips that you would recommend, like, to a client, how to clean up their personal credit so they could get prepared to buy a house?
Yes. So the first thing is you have to run your credit report. You have to know what's on your credit report. So many people are afraid to even look at their credit report, and I was like that 2 years ago. I'm 40. I did not want to look at my credit report. I'll just pay everything in cash. And what woke me up was I was trying to buy a car, and I was making really good money. I had the down payment, and it was like, you need a cosigner. And I was like, why? And it was like, because your credit is trash.
Yeah.
So my husband had to co-sign. And I remember driving home, in my new little convertible, and I was just feeling like, I feel like, like trifling that I haven't been paying my bills, and now bite me because now I want to buy new stuff and, not pay cash for everything. So that's when I decided I'm going to work on my credit. So the first thing I had to do was order a credit report. You can get that free on Credit Karma, or write to all of the credit bureaus and have them send you, a copy of your credit report. The first thing you want to do is you want to get rid of all verifying information of bad debt. So what I mean by that is, so say you live in Long Island, you went to rent a center, you bought all this furniture, and you decided you're not going to pay, right?
Yeah.
Then you move to New Jersey, and now you want to, you want to right the ship. You want to make sure your credit is good. So what you do is you dispute all the addresses that's not your current address from your credit report. And the reason why you want to do that is because the burden of proof is on the credit bureaus. They have to prove that the debt is yours. So the least amount of information they have to work with, the better. So if you don't have an address that they can correlate the debt to, that's one that they can't verify it, right?
So they have no choice by law to eliminate it.
Well, that's the first part, to make sure that there's no address attached to that debt. The next thing that you need to do is freeze all of the secondary consumer reporting agencies, because the big three, which is TransUnion, Experian, and Equifax, they don't really keep that data. They reach out to someone else and say, hey guys, Cal got this thing from Rent-A-Center. Can you verify it? Mm-hmm. And they'll say, oh yeah, Cal was moving real bad in the industry. Yeah, that was his debt. But freeze it. Then when TransUnion reaches out to them, they'll be like, we can't give you that information because the file is locked. So that's a way that you'll be able to dispute, and then they can't verify because, one, they don't have an address that ties you to the debt, mm-hmm. and they can't verify from the secondary agency. So those are my two biggest things to, jumpstart, getting your credit together before your pre-approval, to, clean up your information. So no old phone numbers, no old addresses, and to freeze all of the secondary credit reporting agencies.
And you reach out to those companies directly, right? I think like LexisNexis, I think is one of them.
Right.
That you got to freeze.
In order to find them, the easiest way to do it is just Google like Lexis security freeze. It'll bring up the link. Usually the first link is the link that you would use. And you just fill out like a short application and you just tell them that you want to freeze it or you want to opt out. And you would do that for all of them.
All of them. Perfect. Okay, so let me go to this next question, which is, how are things looking now? Like with interest rates kind of double, how are you maneuvering? It doesn't really matter when it comes to buildings, right? Because tenants are going to cover that. But are you more cautious? Are you like more strategic now?
Yes. So right now, I want to let people know that the interest rates that we had last year was historic. Like hardly that. I don't think that ever happened before. So my interest rate is 2.75%. Wow. I probably never see that again in my lifetime unless there's another pandemic and they're trying to, stir up the economy. The interest rate being where it is now, I think it's probably like 5.5% or something like that. That's typical. It's typical. The reason why people are in a shock because you've been seeing these low rates for so long, right? For like a year and a half. Yep. So I want people to keep in mind that interest rates usually during inflation can go up to almost 18%. So, wow. Yeah. So if you're thinking of buying, you need to get in now because even with the interest rate being 5-point-something%, it's still way better than double digit. Yeah. So that's one thing to keep in mind. The second thing to keep in mind is because the interest rate has doubled, it may make you lose some of your buying power, meaning you won't be able to buy as much house. So that means that you need to shop a little bit better. And that means that you might, need to find a distressed property and do the BRRRR method or do the FHA 203K method to, one, add value and force equity, and two, to be able to, comfortably get into a mortgage that, if something happens with your tenants, and I'm just keeping it 100%, yeah. If tenants can't pay, that you can cover the mortgage. Yep. Even though I preach that, your tenants are going to pay, you always want to cover yourself. You always want to cover yourself and make sure that if anything happens, I can still pay this. Yeah. But, the crux of it is, yes, my tenants are going to pay. I will be a good landlord. It's going to be all that. But, you want to just have that insurance.
Things happen, yep.
So, and now I'm seeing in the market that sellers are realizing that people are not buying because of the interest rate. So I'm seeing prices coming down like $50,000, and stuff that I was looking at the top of the year is it's something that I could be like, let me grab that up. It's a really good time to buy because the sellers are feeling nervous that they're not going to be able to offload their property, and
they want to sell.
And they want to sell, and they're a lot more amicable to sellers' credit. To I remember just a few months ago, people was like, "If you're going to do an inspection, I'm not going to take your offer." But now it's just like, I'll accommodate you. I just want to get into contract. Yeah. So the buyers at this time are in a really good position to purchase and get a good purchase out of this climate that we're in right now.
All right. And one thing that I wanted to mention, because I know I've mentioned this to you before, and I'm not sure if you're aware of it or not, but I currently have it, so I kind of feel great about it. The guarantors, What they do is basically you put your tenant in contract so that if God forbid they can't pay their rent or something happens, they lose a job, you contact them and they'll cover the rent for at least the rest of the year if you needed to.
Yeah, that's dope, and I'm gonna have that for my next when I renew my leases for all of my tenants to get that insurance, because then you don't have to worry about doing evictions and all that kind of stuff. You just reach out to guarantors and they will pay the rent, and you don't have to worry about it. You will still probably have to deal with your tenant because you're like, what you gonna do? You gonna get a job? What you do?
Yeah.
But at least the money part of it is covered. So that's a great tip. I'm glad you reminded me about that.
Yeah, because you never know. That's one of the things that we were worried about. Like me, normally somebody's gonna go out and get a single family, buy a house. It's really not common to go out and look for a multifamily. But for me and my wife, that was one of our concerns. Like what if God forbid something happens to one of us or one of the tenants, and then we can't cover that mortgage, because obviously with a multi is a lot higher than what a single family would be. So I was glad that I found that and did it. So that's why I always recommend them.
Exactly. And the other thing is, it depends on your market, because like when I first started looking, I was looking in New Jersey because that's where I live, and the 4 families are not in abundance. There's not a huge inventory in Jersey for 4 units. And the ones that they did have was like upwards of $900,000 to $1 million. I was like, whoa. And I know it was a mix of, the pandemic and people taking advantage of the fact that it was a seller's market. But I just was like, that's just way too much money for a 4 unit. Like, that's crazy. So that's what made me look in Chicago, because Chicago has a lot of inventory of multifamilies, and the price was like half. And I could also find, if I looked hard enough, 4 families for like $250,000 or $300,000. So
distressed or not distressed?
Some of them would be distressed, but not too distressed.
Okay.
Most of them already had tenants. So if they already have tenants, and you decide that you want to move forward and keep those tenants, you could do a slow rehab. So you can still have that income coming in from the rents, and just tell one tenant, I'm going to work on your apartment first, and then and
gradually.
Just mentally like that, so that you're not overextending yourself financially, and you still have tenants in place, and you'll have a reason to raise the rent once you're done with the rehab. So that's like a good way to get into these more cheaper multifamilies. And a lot of times when you find a multifamily that is that cheap, that's because it's a motivated seller. They probably don't really know how to landlord and how to, get the most out of their property. So they're just like, I'm just going to sell it because, the rent has been $750 for this 2 unit for 10 years, and I'm going to just leave it like that. No, you can go in as a new owner, and for a 2 family in this area is like $1,200. One, off the rip, you can raise the rent. Now, for me, I'm an ethical landlord. I did not raise my tenants' rent when I first acquired this property because it was the height of pandemic. They were on fixed incomes. But my situation doesn't have to be your situation. You have to take full inventory of what's going on in that particular scenario and make the best decisions for you. But do know that if the property is under market, you can raise it to market without doing anything to the property, because that's just what the market dictates. Mm-hmm. But, more than likely you're going to want to do something nice, update cabinets or something like the lights or the carpet or whatever. Just because you're adding value to your property as well when you do that. So not only making your tenants happy, but you're also infusing value into your property as well. So.
And that makes sense, because when you go in, you don't know what you're going into. So if you get, figure it out as you go, then you get better at it.
And then, of course, you had your inspection. So you have a list of things that you can say, I think this is going to be too much for me. So at that point, you can walk away and get your earnest money back. Or you can be like, okay, these things are not so bad. I'm going to get me some home serve. Home serve is a warranty service where they come in and they fix the foundational things like the pipes and electric and stuff. Is $50 a month. That's what I have on my building. And I was just like, I know that.
What's that? Is that like a home insurance?
It's like a home insurance, like a warranty type thing.
Oh, okay, yeah. I have one called Home Shield, and there's a home warranty, and anything goes like I had a water heater go out, and they came and fixed it.
Yeah, and you only pay like that premium every
Yeah.
month, and
Yep.
it's not a big expense. So that's what I did. Like,
That's
this,
good.
I had bought it from an investor who was also a contractor, and he had, rehabbed the property. So everything was pretty much new. But I know, like, in 3 years, I'm gonna have to, make sure that I have my maintenance on this stuff, and the home serve, it does the maintenance. So it's ways that you can get into properties and get home served. So if something happens, you have that protection, and you're not coming out your pocket off the rip for something big.
Yeah. Yeah.
Yeah.
So another question for you. Like, say a person wants to get in, but they're not good at being a landlord yet. They're like worried about that. Do you hire property managers, or you just jump right in full landlord?
I just jump right in because that's part of my personality. But I did do a lot of research online. I bought a lot of courses on multifamily, so I had a good baseline information of what I need to do as a landlord. However, I did know that I was out of my depth when it came to tenant screening because I have a very demanding job and I just didn't have the time. So what I did was I hired a leasing agent, Makia from New Heights Property, New Heights Property Management. Shout out to her. She's a property manager, but she offers these a la carte services where you can just use, her services to get a new tenant, or she will handle an eviction. So I just reached out to her and I was like, could you find me a tenant? And she was like, yeah. And my tenant moved in today, which is
Wow,
cool.
that's
And I didn't
awesome.
have to worry about, am I picking the right person,
Yeah.
getting all these different memberships to run background checks, stuff like that. And it was well worth it for me because it was just like, I didn't have to worry about it. I knew somebody had my back that would, they know that how the scammers work. And because there's some professional bad tenants out here and you want to make,
Yeah. Yeah.
run one of those. So yeah.
For sure. Like for me, I know we're getting close to time. Don't worry, but I'm gonna tell you my story real quick. I used Avail.co. I don't know if you heard of them. It's actually pretty good. You create
Mm-hmm.
your whole profile, and I had a lot of tenants come and I had to screen them myself. But to be honest with you, I went with Zillow Rentals because they did all the screening and backgrounds. Like they did it all on their end, so I didn't really have to do much. I mean, of course, I had to meet them and do the screening, but the background stuff, they took care of all of that, so that helped. But it's
Yeah.
good that you said that because I didn't know that you can do that. Get a property manager to do all the screening for you. I
Yeah.
thought, mm-hmm.
I loved it because I put some keys in a lockbox and they would just showed up the property. It was very transparent to me. Like she would send me reports and stuff like that, but it didn't disrupt my day. And like I said, I have a very demanding job and I just couldn't focus enough to find my own tenant. And I was just like, I don't want to, mess up and get somebody in here that's, only going to pay the rent once and then I'll whole,
Yeah.
situation trying to get them out. So the tenant that I have, she's through Catholic Charities, and they're going to pay her rent for the year. So it's like a Section 8 kind of thing, but not
Okay.
Section. And I love the fact that also Makia introduced me to other ways of getting tenants that's going to pay market rent, not just Section 8. Section 8 is great, don't get me wrong, but there's other opportunities out there like veterans and disabled individuals that's highly functional. That is a lick. I'm actually doing some more research on that because I want to share that whole situation with you, like getting highly functional disabled people in your properties. Basically, all you do is you provide the property, and their caseworker handles everything. So if there's something wrong with the toilet, the tenant, they call their caseworker. The caseworker sends out a plumber. Like it's totally
Wow.
off, and you get paid every month from the government. It's amazing. But when I
Okay.
have more information and I can, put it in a very shareable way, I'm gonna share that with you guys
Thank
because
you. Yeah, appreciate it. Yeah, I remember one time my agent sent me a situation like that. It was a government form to fill out, and I didn't understand it, so I kind of backed away from it. But it,
right,
it was it was exactly that, a disabled individual that was getting government help, and the government would pay on their behalf. But I didn't understand like the logistics and the law behind that, so I got a little like put off.
yeah, that's what I want to do. I want to break that whole thing down and make it digestible so that we can be getting that kind of money too, because it will triple your rental,
Yeah,
instead of
yeah, yeah.
$1,000.
And I heard the government pays on time. All right, so this is gonna be my last question. I hope it's a decent question, right? Let me see real quick. All right, so if you go out what would be a property of value for you? Like, what would catch your eye? Like, what is something that you'd be like, yes, I want this property?
So I'm learning to become a shark, because in this environment, it is still male dominated. So the men, they like to do business with men, right? So that's one thing that me as a woman, especially by myself out here alone, doing that, I feel sometimes that I need to really bring it when I'm talking to people. So I've gotten a little bit more aggressive in my offers. And so now when I'm, putting out an offer, I tell them I need to answer 24 hours because, one, that's just because I really want the property. Yeah. But two, I'm putting the pressure on them to make a decision fast so I can move fast. Yeah. Because I already got my contractor, he's ready to go. So as soon as I can lock up a property, I can move. So that has been working pretty well for me. When I give that, I need to answer
time frame. You need to know now, are you walking?
Exactly. And that's been working pretty well. I actually have a property under contract with that method. But I learned that because I lost a 22 unit deal in Ohio to somebody that did that. So they, I had put in my offer, $600,000 for those properties, and he put in, I think, like $550, and he was like, I need to answer by the end of the day. And the seller went with it because he felt that pressure. Yeah. It fell through because the guy couldn't get the money, but
that happens too, right?
Right. Yeah. So, and then with that strategy, if the person takes too long to answer and they say, like maybe a week later, they say, yeah, I'll take the offer. I'm like, well, that offer's off the table. Now it's $10,000 less. Do you want to rock with me? And they'll be like, yeah, give you an answer right now.
They get desperate at that point.
Exactly. So I think, especially now with it becoming a seller's market, you're in a position, a buyer's market, you're in a position to be a lot more strategic and a lot more thoughtful in your process. Yeah. And when you see something, you just want to pounce on it right away. And you want to create that urgency so that the seller isn't, hanging.
They know you're not playing. Like you do business.
Yep. Exactly. And but my focus right now is I really want to get into a really big multifamily, like a 22 unit, a 30 unit. So I've learned about commercial multifamily real estate from Ramel. I post about him a lot in my stories, but he teaches about acquiring commercial. And I had no idea that was a whole different beast. Like I was approaching it in the same way that I would residential. I came across a 12 unit for $199. $199 out here, guys.
What? That's unheard of.
Crazy, right? Probably
Where? Chicago? Out there?
Yeah.
Okay.
A 12 unit for $199, all brick building. The construction was probably going to be $250, and that thing, the value for it after, because commercial is based on cash flow. It's not based on comps like residential is.
Oh, that's a big difference.
Yes.
Okay.
The value that you add and the cash flow that you can get from that property is what determines the value. And the value for that would have been like $500,000. So I would have been in for like $300, and it's worth $500,000 plus the cash flow would have been bananas
off the jump.
So that's where my focus is now, because the opportunities out here is just so great. It is a little bit more challenging for financing because
the down payment's a lot higher, right? 25 or 20, I'm not sure.
It's still around 20, depending on your relationships with banks and stuff like that. But that's where, JV deals come in, private money, doing a group effort. So say like you was like, well, Zena, I want to get into that. So then we pool our money and then we can just negate the banks altogether for the purchase, and then, go in and get a construction loan much easily because we've already acquired the property. So that's what I've learned.
You could do that? I didn't even know that was possible. Wow. Okay.
It's so many creative ways to get into properties. Like I've learned about master leases. Master leases is basically you going to the seller and saying, I'm going to take over the lease. I'm going to take over all the responsibility. I'm going to still pay you the debt service, which is like the mortgage, and I keep all the profits. So all the value that I add to this property, I keep as long as I pay the debt service. Because you do a master lease, the seller keeps the mortgage or the loan in their name.
Oh, okay.
You follow me? They keep it in their name, and
so they own it technically, but you're covering all the expenses, right?
They own it. Your name is on the deed.
The deed, okay.
Right? They still own the loan.
Gotcha.
Loan, but you're on the deed, so you're the owner, and you have an agreement with them that I'm going to pay the mortgage. You don't have to worry about that. But any value that I get, the profits, the rent, the cash flow, all of that goes to me. My only obligation to you is to pay the debt service. So
even the equity, even if the equity builds, that's yours.
Even the equity, everything.
Wow, that's a gem right there.
Master lease is dope. Financing, that's another thing where you can, especially for the smaller, like 4 units, somebody's, eager to sell, they're motivated, but you don't have the money. You might say, let's do, you hold the mortgage and I'll pay it. So you keep the loan in your name, especially if they have a low APR. So say for instance, you wanted to buy my building. I'm motivated because I want to move to Bali, right? And you say, Zena, I want a building, but I don't have the money, the down payment to do all the bank stuff, right? So can you hold the mortgage and I just pay, the mortgage, but I control the building. So what you're going to do is you're going to get a mortgage that's only 2.75%, right? Yeah. And you're going to get the cash flow. Any value that you add to this building is yours. The only thing I'm doing is holding on to the mortgage in my name. And it's all very legal. It's contractual, of course. Yeah. And that's like a really good way for people to get into properties, especially now because so many people are motivated and they're seeing what's happening with the banks. The banks are very trepidatious. Some banks are closing, but people get out of these loans, they can't afford it. So you providing a solution, it just locks it up for you.
You kind of help, you save them, basically.
Exactly. You save them.
That is great. Oh wait, I got like 3 minutes, right? So, and for my situation, right before we bought this house, we actually bought another house, but they had some issues where they were being very tough on me, right? They were putting the pressure on me. And when I had my inspection done, they had issues with the foundation and other stuff that I was like, I can't move with this. I need you guys to fix this, this, and this. And you need to decide that now. And they took their time. I took my earnest money and I left.
Right.
But I ended up finding out, well, back up a little bit with, they told me that they had other offers, but I ended up finding out that they didn't, because when I told them I'm gone, they were like, please. They ended up offering to lower the price and fix everything. And I was like, but what about the other offers? So I don't know if they be lying when they say that.
They do. My one of my realtors, he was like, we're going to do an escalation clause because we want to know for a fact that you do have other offers, because
well, that's the thing, you can find out.
Exactly. If you have an escalation clause in your contract, that means if someone says, if the seller comes back and says, oh, somebody offered us an additional 10,000. Okay, I need proof. That's what the escalation clause is.
What's it called? Escalation?
Clause.
Wow. Okay. Damn. See, these are all gems. We need to talk more.
Yeah. Yes. But
all right. So I know that you gotta go, so I don't want to hold you up time. I want to make sure that everybody knows that you're doing this. Everybody wants to do this, and sometimes you get caught up with the reading, with the studying, and you get afraid to do the things. But I noticed, like from you and from myself, that diving in and learning has been the best thing ever, because you don't know what you're gonna get into until you try it, right?
Exactly.
Just utilize the funding accordingly and make it work for you and make sure the numbers work out so it makes sense. But I thank you for your gems. Continue to do what you do and let the people know what they can find, what you offer real quick before you go.
Oh yeah. So I do have a webinar that I did a couple of weeks ago, and I lay out everything, all the gems, and how to get into your first multifamily property with the least amount of money out of your pocket. That's what I teach to my clients in the one-on-one consultations. The difference between that webinar and my consultations is my consultations are geared to your specific issue or circumstance. So I help you run a play that's going to be beneficial to you in your particular circumstance. So that's the benefit of the consultation. But if you just need that foundational information to action and buy your next property within the next 60 to 90 days, the webinar is great. It's in my bio. And I'm always like, you know, dropping gems and, you know, sharing my story in the story. So if you want to keep track, you could just check it out there.
Sounds good. Thank you for your time, Zena. We'll stay in touch. I'm happy that you've done this. You're so great. Thank you.
I want to tell you that one thing that I didn't want to forget about distressed properties. Okay. So with NACA and with FHA, you can buy a distressed property. But the lick in that is, say if you found a single family or a two family in an area where there's all multifamilies, like there's all 4 units and 5 or 6 units, right? If that property that you have your eye on, that's a single or a duplex or a 2 family, if that is actually zoned for a 4 unit, your construction loan will pay to convert it from a single family or a duplex to a 4 family.
Wow, really? I did not know that. So,
yes.
So how do you find that out? You have to check your zoning, like what zoning you're in?
So say you're driving for dollars or whatever, and you see this little house in the middle of this block with all these 4 units. The reason why that is because that house has probably been there a really long time. And maybe they wanted to buy the land so they can buy, you know, make a 4 unit, but the seller was like, no, I like my little bungalow. I don't want to, you know, I don't want to sell you my land or my house. And, you know, maybe, you know, now this person is older, or they passed away, or they left it to their family. And you see like, wow, this is so odd. Like this one little tiny house on this block with these 4 units. What you would do is you would just call up your realtor and say, what is the zoning on that property? If they say that the zoning changed from a multifamily to a 2 unit, that means that you could easily change it back to a 4 unit, because that's the zoning for the area. And these construction loans will pay to convert it back to a 4 unit. So could you imagine the value and the equity that you just forced into that kind of play?
Yeah, that's insane. I never even heard of that. So
yeah, so, and you can do that with FHA 203K, and you can do that with NACA. I just want to do one quick thing with NACA. NACA is an owner-occupied loan, just like FHA. However, FHA, you only have to be owner-occupied for a year. With NACA, you have to be owner-occupied for the life of the loan. So if you decided, oh, I want to buy more property, either you would buy your next property conventional or hard money, or, you know, what have you, or you would refinance out of NACA into a regular conventional loan. However, NACA has the best loan product ever. So I would behoove people not to refinance out of that, because you might get a mortgage for like 2.00, you know.
With NACA.
With NACA. NACA is amazing. If you can, you know, stomach the long time frame, because it usually takes like 8 to 12 months to get through their program, because so many people want to use it. And they're
you have to apply for that program in order to get it. Okay.
Yes, you go through a whole program, and they also give you landlord training, which is a bonus when you buy multifamily with NACA. But they just want to make sure that you're good to go in terms of your finances, that you're good to go with your credit. So it's like
is there a cap for that loan? I know like FHA, like for New York, the cap I believe is like 1.2 million. Is NACA has the same rules?
NACA, from what I saw, there was no, actually there is a cap. It depends on the area. I don't have the specifics, but there is a cap. But there is no income cap, which I think is weird. Like, you could be a millionaire and use that.
That's weird. That's crazy. Well, so I mean, I can see the benefit already, because FHA has its rules too. But NACA, if it has no income, Like you could be a millionaire and just keep acquiring houses with nothing down.
Crazy. It's crazy. But as far as I know, the last time I read on their websites, there's no income, cap in order to use these programs.
Wow. So you can use it whether you have income or not, like both ways, right?
So if you have to have some income with both, right? Because they do want to make sure that you can pay the mortgage. Yeah. However, there is a caveat with NACA. There's a lot of caveats, but with NACA, if you're a Section 8 voucher holder, you can use Section 8 to pay your mortgage with NACA.
Oh, wow.
Isn't that crazy? Yes.
That's a gem.
So, because they're a nonprofit organization, and they are real advocates of people owning, especially people in the Black and brown communities that are not privy to information about owning property. Like everybody, especially when I was growing up, Section 8 was the thing to get. If you could get Section 8, you were straight. Yeah. Nobody talked about let's own a house or anything like that. So they are real advocates of people trying to build wealth through home ownership.
Wow. See, you're awesome. Thank you.
You're welcome. Did anyone have any questions before I go? I'm sorry, guys. I have to go. I have to go back to work.
Let me see. I don't even know what's going on in
here. And
escalation clause. That's great. Yeah. Oh, somebody wrote that. That's great info.
Yeah.
But yeah. If anybody have any questions, you can ask Zena herself, or you can ask me my DMs, and then I'll forward questions however it plays out. But thank you for your time. Let's catch up whenever, and I'm here to help you as well. So if you need any graphics, any marketing, I got your back.
Yes, Cal is a beast with the marketing and graphics, so reach out to him if you need anything. But thank you again. I really had a good time. I've been anxious all day just thinking about this thing, but it was Jermaine.
Oh, last question before you go. Are you buying property under LLC or personally?
So when you are using FHA or NACA, you cannot buy under LLC because they are not in the business of making you an investor. This is a hack to get your first investment property, but you don't want to divulge anything to any lender about this is my investment property. You're just a home that wants to buy a 4-unit. Once you refinance out of, say, your FHA, you can refinance and you can get your title put under the LLC.
After the fact.
Right. Okay. With NACA, that's the life of the loan. If you refinance out of it, then you can put it in an LLC. But for these two programs, you cannot. It's just your personal name. And you want to keep it like that because, one, everything is cheaper when it's under your personal name. Yeah. Your homeowner insurance is cheaper. Everything is just cheaper. Once you start putting stuff in your business name, everything goes up. So you wanna maintain your bottom line as much as possible until you start to scale. So
buy under FHA or NACA, and if you want to get out of that so you can buy more properties, refinance out into a conventional and then use FHA or NACA again, correct?
Yes. Okay. Well, you can't use NACA again.
That's right, because that's a forever loan, pretty much.
Right. It's a forever loan. And if you have financial interest in another property, they will not give it to you. So the way that you can get around that is someone else buying the property under NACA. So say you and your wife wanted to have properties, right? You buy a property. Well, just say you and your girlfriend. You're not married yet.
Yeah, I was going to say I might have to get a divorce for that.
So you buy a property under FHA. She buys one under NACA. If she wanted to buy another one, she could, be on the deed of another one with like a family member, like her sister or, something like that. That's the only way that you can get 2 NACA loans with you having ownership in the loan, if that makes sense.
You've been reading for hours, I can tell. Yeah, this is all gems. All right, I'm gonna let you go because I know you gotta go. And thank you for your time. This was awesome. We should do this again.
Yeah. Thank you so much, guys. Thank you for everyone tuning in. Thank you, Tremaine, for dropping the link. I appreciate it.
All right, bye-bye.
Bye.